Go to the markets. Join us now, Anastasia Amoroso, Chief Investment Strategist at iCapital. Where have you, I can't remember the last time you were on, Anastasia, but we've had a lot of data points, a lot of Fed speak, we've had inflation numbers, and we've ratcheted back how many cuts we're going to get. How are you feeling about the prospects for stocks and bonds for the rest of the year?
Yeah, well, good morning, Joe. I'm feeling pretty good about the prospects for stocks. And I think the last time I was on with you was actually in December, and we talked about looking to this year as being the year of a greater opportunity set for investors and a year of broadening out. And we clearly have been seeing some broadening out, even though tech is still leading the way, but you do have sectors like energy and financials and industrials that are starting to participate more and more in the rally. So feel good about that. And then generally speaking, Joe, I think despite, the near-term overbought conditions that we've actually had since December, and despite, us hitting new record highs, I think stocks do have staying power. And I think the big development in the last few months has been not only do we have the prospect of the Fed cutting interest rates, but we now have growth that's once again surprising to the upside and is remarkably resilient. So that's why stocks have been in such a sweet spot, because multiples are supported by the prospect of rate cuts, and revenues and margins and earnings are supported by better than expected economic data. So I think that's the status quo that can continue for a bit.
It's the opposite of what we were worried about, and it's the greatest situation you can have. I mean, stagflation's the worst, where you have high inflation and stagnant growth. And if you have strong growth and declining inflation, I guess we shouldn't be surprised why that's happening. Why? Can you explain gold's breakout, Anastasia?
Yeah, well, I think there's a number of reasons for that. First of all, if the Fed does actually cut interest rates, then, the time of high real interest rates that the U.S. dollar investors have been enjoying, that time might be behind us. So that's why investors have been turning to gold. That's why they've been turning to Bitcoin, because if real rates fall, that bodes well for those sort of alternative assets. That's one point. And then, as calm as things are, Joe, in the equity markets and the U.S. economy, we know that things are not calm in places around the world. And once again, I think that's why investors are seeking out some of these havens from geopolitical instability. And that's why you're seeing some of the upside move in gold and Bitcoin as well.
What's more concerning, that we have that we don't have inflation under control? I mean, that could be why gold is moving too. All the debt overhang, the interest payments that we're facing. You'd like to bring rates. You'd like to bring rates down so that the debt service is lower. But a lot of times, if you have a lot of debt, inflation helps. What you're paying back is not quite as much as what you borrowed. So I mean, policymakers and central bankers have a lot to deal with, and it's a difficult period, I would think, for them.
Look, they do have a lot to deal with. First of all, I want to make 2 points on that. First of all, with core PC expected at 2.8%, that's to be reported on Friday, that gives a lot of wiggle room for the Fed to cut interest rates. And so, while there might be some concern that inflation stays sticky around these levels, I do think we are on that downward trajectory. So that gives the monetary policymakers wiggle room. But, there is a big concern that we sort of haven't talked about since August to October period of last year, which is the $26 trillion of the U.S. government debt that needs to be refinanced over the coming years, and is being refinanced at much higher interest rates. We just had an update from the Congressional Budget Office about sort of this unsustainable trajectory of the U.S. government debt. And look, Joe, if we were talking about this, 10 years ago, and a lot of clients were asking about how concerned we should be about the debt, you don't have to have a concern if interest rates are zero. But if interest rates stay at 5.5%, or maybe they fall to 4.5%, that's still a mountain of debt that needs to be refinanced. So I do think that as a nation, as a government, we need to address that trajectory. And, perhaps that comes from different levers that we can pull, raising revenues, but also cutting expenses. But the key thing is we need to have the willingness to fix that before the market start to push us in that direction.
The tech trade is tired or not at this point?
Well, near term, right? If you look at the, again, overbought conditions, we've been there since December, but I am still a big tech bull. And, look, the artificial intelligence hype, people say that maybe it's hype and maybe it's tired. But the thing is, if you take a step back and if you think about the massive amount of data that we have in the world today that we're not doing anything with, I think some of the numbers from Google from years ago, we're analyzing 1% of the data that we have today. We can't possibly humanly process the rest of it. So if you think about it from that perspective, the possibility to make use of our data using artificial intelligence is not a multi-quarter, it's a multi-year, maybe multi-decade opportunity. So when I look at it from that perspective, that's a trade that's certainly not tired. And then the other thing, Joe, that's really notable, we had some updates from NVIDIA and Broadcom and Microsoft and a few others. And what's evident is that hyperscalers right now are hyper-focused on investing in the entire AI ecosystem. And that's not just, one data center here is there, but it's everything that goes along with it. So it means you need the compute, and the likes of NVIDIA benefit. You need, some of the networking connectivity chips. You need some of the storage and memory and so forth. So what's really interesting to me is I don't even think the tech trade is tired, but I think the AI trade is actually broadening out, and it's a tide that's lifting a lot of boats.
Right. You don't even have to pick the AI winners because it's going to be used by almost all of technology is going to, in some way, could benefit theoretically from AI. So you can just maybe.
Well, the tech companies are going to enable it, and that's why you stick with them.